Right now, the headlines are full of conflict between the United States and Iran. Investors are hearing things like missile strikes, retaliation, oil disruptions, escalating conflict. One of the most natural reactions to that is fear, concern, among other general concerns that people have. Clients start asking questions like, should we get out of the market? What happens to the stock market or the economy during wars? And is my retirement portfolio safe? We'd say that reaction is completely normal and justified. The one thing that we would want to point out is that when emotions are high, it helps to step back and ask one simple question, which is, what has actually happened to markets during wars in the past? That's where historical market or data becomes more helpful.
1, 2, 3, 4.
Gentlemen, how we doing today?
Good.
Yeah? Anything new and exciting?
No, going to end of next week, going to Hawaii for a little over a week, which is with the whole family, which we're really looking forward to.
Yeah, it'll be fun. We're going there for a wedding. Actually, some of our clients, some of their kids are getting married. Well, one of their kids is getting married, so it'll be fun. Nick, anything new with you?
Just waiting for the golf season to get here. We're so close.
I went down.
Kind of are here.
I was in Florida for a bachelor party not too long ago with some buddies, and we actually snuck in 2 rounds. The first round,
Tough.
I don't want to talk about it. The second round, I actually was very happy with how I did. So
good.
I think I'm going to try to go this weekend if I can. But gentlemen, the topic today, I mentioned it at the beginning of the episode, is really going to focus heavily on the conflict between the United States and Iran. It's obviously been all over the news. Just from talking to clients, I know there's some concern there. What we wanted to do is focus on that, number one, but also just talk historically, because we've been through situations like this in the past, and just kind of break it down and just talk about how the markets and the economy as a whole have reacted in the past. So, Ron, I'll start with you. When you look at market history, what does the research show during times of conflict?
Do you ever notice I always get the history, the parts,
data.
and I guess because I've been around so long, I guess that's what I'm guessing. But so one thing's
it might have something to do with the gray hair. I don't know.
So one thing's very clear is that the markets have been through this before. A lot of geopolitical events. I mean, if you look at World War I and II, Cold War, Vietnam, Gulf War, 9/11, Iraq, Afghanistan. There's been numerous ones. Recently Russia, Ukraine, and during all these times, the markets have continued to grow. I'm not saying that.
When you say they've continued to grow, do you mean just over the long run or during those specific situations?
Well, kind of both. We'll go over in a little bit the near-term reaction and the longer term.
Okay.
But longer term, wars can have an impact on inflation, somewhat due to like commodity and energy prices, global trade, especially those countries involved in it, and that could spill over to economic growth. We've been really fortunate in the United States that we may have been in some wars, but it hasn't been on our turf, which helps out a lot. And so what really matters long term is, how is the economy doing? Are we being innovative? Are we, increasing our productivity over time? And that all translates to, are our company's earnings growing? Because when the earnings grow, the market tends to grow over time as well. And so again, they matter more in the short run, short term than in the long term.
So I think the takeaway there is that wars absolutely do matter, but that doesn't by default mean that it's the end all be all.
Exactly.
So, Nick, I'll pass it over to you. Can you just explain why markets react so quickly to these types of conflict?
Markets process information extremely quickly. And you can almost think of markets as a giant computing machine in that sense. So whenever there's a big event like geopolitical conflict, immediately what starts to happen is everyone in the market reassesses risk. Everyone adjusts their expectations about the future, and everyone repositions based on that, which moves prices. So by the time it's a couple days out and someone is reading the headlines, reflecting on their portfolio, reflecting on what the tape is doing from a market price standpoint, the new information has really already been incorporated into prices, or at least to a significant degree. So that's why it's very difficult to trade around this kind of geopolitical news, because when you think about what was just described, you almost end up chasing your own tail, right? You're chasing information that's already been priced.
So when you say everyone reassesses risks and everyone, kind of reevaluates expectations in the future, do you truly mean everyone, from like the retail investors to, Wall Street or the firms that we would get research from for outlook going forward? Or is it less retail, more kind of like Wall Street and the large companies setting expectations for the future?
The information processing part happens more at the large Wall Street, large investment firm level. Yeah, that doesn't mean that retail investors don't trade.
Right. So, Ron, let's go back to you. And if this is, I think this is also kind of historically, so I think there's a theme here. But what usually happens or has happened in the markets during wars in the past?
So at first, the event shocks the market. Short term, the markets fall. And what's interesting, the initial decline in the market is normally around 3 to 9%. So it's not as bad as people may think. Short term, the volatility increases, but then things stabilize.
So that short term adjustment, is that more of like for lack of better words, an emotional reaction from the market? Hey, this is surprising news, don't know how to interpret it. That doesn't necessarily mean that that's what it's going to look like even 2 months in the future.
Well, yeah, I mean, so first of all, it is surprising news, and if it's negative and a surprise, it tends to short term affect the market. A lot of it's sentiment. Then after that, it's like Nick was saying, it's kind of a weighing process. How much is it really, like what is it going to really affect?
As new data comes out, the market's going to react, like Nick said earlier, very quickly to that.
Exactly. So the longer term, as I mentioned before, fundamentals, the health of the economy, inflation, interest rates, things like that end up being much more important longer term. And what's really interesting is there's something called the war puzzle, which this will surprise a lot of people. And what studies show is initially there's a reaction to the markets, as I mentioned, about a decline of 3 to 9%. But afterwards, the markets have actually been somewhat more stable after the initial shock, which can, again, surprise a lot of people. And a lot of economists are trying to figure out like why that is, and some people think it's because government spending increases, maybe with military. It doesn't affect every country the same, as I said before. And then the countries that import a lot of energy or commodities tend to be impacted more than those countries that are exporting. And fortunately, with the U.S., it's not on our soil. Hopefully, it doesn't come to our soil. And also, we are pretty energy self-sufficient, so we're able to weather the storm very well. Other countries like India and China that do a lot of importing of energy are definitely more impacted. And Russia, actually, Trump just gave the green light for Russia to export, like for countries not to be penalized if they buy oil from Russia. So actually, short term, Russia's actually a beneficiary of this, which is kind of surprising.
Do you think that this is more of like a personal, I guess, not personal, but personal take on that situation? Do you think that's kind of a way for Trump to kind of smooth it over and make sure that during this conflict, Russia's not getting upset and that it leads to something larger?
I don't think it's so much him worrying about Russia. I think it's him worrying about oil prices around the world being high, sure, which can slow the economy down and also impact the inflation, right? So that one of his objectives is to lower inflation, and short-term high energy prices do not help.
So the bottom line is that wars can create a short-term shock, sometimes, more often than not, a negative shock to the markets. But long-term, the market is smart enough to kind of take the emotions out of it and focus on economic growth, innovation, corporate earnings, just the same thing that the market focuses on in a normal bull market environment.
Right.
Okay. So, Nick, let's dive into investor behavior during times of conflict. Can you just walk us through, the biggest risk, how people react, et cetera?
This is a recurring theme that listeners people have listened to a lot of our episodes.
And it's not just wars either. It could be other things too.
Right. The biggest enemy tends to be ourselves, actually, or our own behavior. And it's this same pattern, and it comes up whenever something unsettling or scary happens. It's market falling, I'm uncomfortable, cash feels good, I'm going to sell the cash, and then I'm going to wait till it feels safe again. Mm-hmm. And from a human perspective, we're like evolved for that pattern, right? When you think about humans back in the day, and it was like saber-toothed tiger.
Back in the day, you mean way back.
Damn.
No metaphors today.
Wow.
You said dinosaur earlier, so in my mind, that's fair. It's clean.
Saber-toothed tiger. Saber-toothed tiger. Run, get safe. Hide, tiger is gone, I can come out again. Right.
Or like
very rational.
Or like Monty Python, run away.
right. But the difference.
I don't get the reference. I'm too young.
That's
it. What's different about markets, though, is in that domain, there's that whole information processing dynamic we talked about before, which means that whole loop of like danger, wait to be safe is not appropriate. It doesn't work as well, because what's happening is by the time you realize there's danger, it's already reflected in prices. So safety happens before you feel safe, basically.
Schedule your complimentary review with Ryan and his team today. Just visit them online at wyzewealthadvisors.com or call 724-271-7019 to get started. That's 724-271-7019 to get started.
We always, of course, we don't want to just sit here and record an episode on current events and, give you our take. What we want to do is actually talk to you about how we are, navigating our clients through this situation. And we primarily do that through our all-season framework, which we've done episodes on that in the past. But gentlemen, just kind of both of you step in when you want to, but can you just speak to our clients, tell them what's on your mind and what we're doing on the portfolio side to kind of navigate through this.
Okay. So I built this framework. We call it the all-season framework, and what we try to do is to position portfolios with different asset classes, and we're trying to, no matter what happens, try to smooth the ride, make it a decent return but less volatility. That's our goal. We do not have a crystal ball. Okay, it's a matter of positioning assets and adjusting. If I tried to time the markets, when to be in or out, or hey, buy defense stocks today because there's a war going on. If I did stuff like that, I'd probably be fired by clients 5 or 10 times by each client, if that was possible. Which of course it's not, but it wouldn't go very well. So with the all-season strategy, if you really think about it, two things can really happen as a result of war. One is that the economy can get stronger or weaker, and the second one, which we've been talking about, is inflation can increase or decrease. And so, again, we try to position assets so that no matter which of those happens, that we're pretty well covered.
Right. And we've already actually seen some early signs of inflation picking up, gas prices, et cetera.
Absolutely right.
Nick, can we use the framework to think about the current conflict in the Middle East?
This is what's great about the framework is there's the theory, but it can also be used very practically. to clear up some uncertainty that people may have. So, okay, think about conflict in the Middle East. What economic effect is that likely to have? Well, disruption of global oil supply is the number one concern, right? And historically, that can create an environment that is very challenging in some ways because economic growth slows and inflation can go up at the same time. Traditional stock and bond portfolios can struggle in that environment. We've seen it before. So there was Ron might remember this, the oil embargo in the 1970s, the Iranian Revolution, actually.
Zing.
But the thing about the framework that Ron was talking about is even though that's a difficult environment for traditional portfolios, we own some assets that can actually help insulate even in that difficult environment. Ron, do you want to talk about that?
Sure. So the stock market short term, as I mentioned, will react. Longer term, it's all about the fundamentals.
Right.
Okay. But on what can help is a couple of things. I mean, one, you could add commodities to your portfolio. We don't really do much of that because history has shown that the return has been similar to inflation, around 3%, and they're quite volatile. So it acts as a drag on your portfolio. Now and then it can help. So what we'd rather do is focus on cash flow. Right. So on our bond portfolio, we have it set up so that half of it is very, very defensive when it comes time to increasing inflation, increasing interest rates. So part of it is an adjustable rate treasury. So treasuries, you have great credit quality, and if inflation goes up and interest rates go up, they pay you more, so the prices don't necessarily go down. On the other side of it, we have private debt, and private debt starts off with a very, very attractive yield, and when interest rates go up, it's adjustable rate again, meaning that they'll pay you more. Now with private debt, you have to be a little bit more concerned about credit quality. So if it was a really bad recession, that could be impacted. But that's where the regular treasuries come in. So again, we have different assets. So no matter what the environment is, we're decently covered.
So, and we've actually seen that because we have been using the private credit for a while now in a higher inflationary environment, and we've seen that work well for our clients.
It's been incredible.
Question that I have for you is, for the floating rate treasuries, do you switch to those in an environment when you're worried about higher inflation, or is that always incorporated in there? The treasuries are obviously the more liquid part of the bond portfolio.
Right.
But are you using, when you're not concerned about inflation, are you using different treasuries other than the floating rate?
Yeah, it's always in there to a certain extent, depending on the how conservative or aggressive a portfolio is, but it's always in there. And what our belief is as one asset class runs up,
It becomes more expensive.
We trim it to try to find assets classes that on a relative basis haven't really run on a relatively, are cheaper. So it's just a matter of you have a well-designed plan and then you adjust based on market movements, adjusting those things that are running and getting more expensive.
So as a takeaway here, I guess my final question to you guys would be, overall, just like your sense of comfort with navigating our clients through this conflict with the all-season framework. How do you guys feel?
I'm sleeping well.
Yeah.
Nick?
I also am sleeping well, specifically because the framework is a map, right? So back to the information thing, right? News comes out, okay, we have a map. We look at the map, and it's like, does the map show that we're covered? We are. Sleep well at night. Yeah.
Well, that's good. I appreciate the context there. I think this was obviously a timely topic, so I hope that our clients that are listening to this benefit from the information. And per usual, if you have questions, do not hesitate to schedule time with us. We are certainly happy to walk you through your portfolio, how it's been performing, further this conversation. And the other thing too that I would say is obviously this episode's more focused on the portfolio management side, but another thing that we can do on the retirement planning side, if you do have concerns, is we're not going to sit here and tell you this is what you have to do. We can show you your options. We can run stress tests in your plan. We can show you very drastic scenarios like, hey, if you did go to cash or half of your portfolio went to cash. How does that impact you long term? So we're happy to have those conversations, and we hope that you benefited from this episode. Thank you.
And I'd like to just add one more thing. If you like the episode, please like it. And if any of your friends, family members, you think this might help them, feel free to share it with them.
Yep, perfect. Thanks for tuning in.
This episode's content is for informational purposes only. Opinions expressed herein are solely those of Wyze Wealth Advisors, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by our firm as to other parties' informational accuracy or completeness. All information or ideas provided should be discussed in detail with an advisor, accountant, or legal counsel prior to implementation.